Hi. Let's learn about account in trust. An account in trust or trust account refers to any type of financial account that is opened by an individual and managed by a designated trustee for the benefit of a third party per agreed-upon terms. For example, a parent can open a bank account for the benefit of their minor child and stipulate rules as to when the minor can access the funds or assets in the account as well as any income they generate. In most cases, the trustee who manages the funds and assets in the account acts as a fiduciary, meaning the trustee has a legal responsibility to manage the account prudently and manage assets in the best interests of the beneficiary. Accounts in trust can hold different assets, including cash, stocks, bonds, mutual funds, real estate, and other property and investments. Trustees can vary, as well. They can be the person opening the account, someone else they designate as a trustee, or a financial institution, such as a bank or brokerage firm. Trustees have the option to make certain changes to the account in trust, such as naming a successor trustee or another beneficiary. The specifics of accounts in trust can vary depending on the type of account, terms outlined in any trust agreements, as well as applicable state and federal laws. One example of an account in trust is a Uniform Gifts to Minors Act account. This type of account in trust created allows minors to legally own the assets held in these accounts. However, they can't have access to the account's principal and income until they reach legal age. This type of account in trust is typically opened by parents to fund their children's higher education expenses and to secure certain tax protections. Another type of account in trust is a payable on death trust, also called a Totten trust. These accounts are essentially bank accounts with named beneficiaries who can legally take possession of the trust's assets and income upon the death of the individual who opened the account. In the housing world, an account in trust is a type of account usually opened by a mortgage lender. The lender uses this account to pay property taxes and insurance on a homeowner's behalf. This type of account in trust is also called an escrow account, and funds to be deposited into it are usually included in the monthly mortgage payment. Before setting up the account in trust, review your available options and choose the one that best suits your needs. Once the details are confirmed, complete and file the appropriate paperwork, according to the rules of your state. It might be best to consult an attorney to ensure that the account in trust is established according to your preferences. Accounts in trust are preferred by many because they avoid probate, enabling a quicker and easier distribution of assets. These accounts also may provide favorable tax benefits, such as the IRS considering income as trust income, which usually results in a lower tax liability. Mr. and Mrs. Q. Sample are school teachers with a goal to retire in 15 years. They have 3 adult children and 2 infant grandchildren. Hoping to secure their assets and create college funds for their grandchildren, they explore accounts in trust as options. If you have assets and specific preferences in how and to whom they are distributed, a trust account might be beneficial. Speak with an expert, such as an estate planner, advisor, or attorney to explore what trust accounts are available and which ones are advantageous for you. After deciding which trust account to establish, outline the conditions you want to be specified within the trust. Draft the trust document, according to the rules for your state. Be sure to name the parties to manage the trust, as well as the beneficiaries. Then, create an account for and transfer assets into the trust. This can be done with most banks and financial institutions. Before establishing a trust, it might be helpful to seek advice and guidance from a professional. A revocable trust is a trust in which the terms can be modified or revoked by the grantor. In contrast, an irrevocable trust is a trust in which the terms cannot be modified or revoked without the written consent of the beneficiaries. The terms will and trust are often used interchangeably, but they are quite different. A will is a legal document outlining the final wishes of a person upon their death. It is only effective after its originator dies. Here are 5 key takeaways. 1. Trust accounts are managed by a trustee on behalf of a third party. 2. Parents often open trust accounts for minor children. 3. An account in trust can include cash, stocks, bonds, and other types of assets. 4. Totten or payable on death, POD. Trust accounts allow beneficiaries to claim the account's assets upon the death of the account holder. 5. Account and trust accounts generally avoid probate, making it easier and faster for the account to be settled. Hope this would help. Thanks for watching.